Hello and welcome to the Genuine Learning Vlog. My name is Melissa Galasso and I'm excited to be here with you this week to talk about a standard that was just proposed by the GASB that we've all been waiting on coming out here, which is the financial reporting model improvements. So we talked earlier on the vlog about the conceptual framework changes that are really going to highlight and be underlined in this area. So this standard came out this month, July 2020, and comments aren't due until February 26th of 2021. So again, we have a little bit of time available for comments and responses, but they wanted to be understanding of COVID and the fact that governments have different busy seasons, right? Some have 5/31 year end, 6/30, 9/30, 12/31. They wanted everyone to have an opportunity to be able to respond. And so you can see here a quite long opportunity in terms of the comment due date. So the prior to this is obviously exposure draft, which is the last stage before we actually issue a final standard. We started with an ITC, then we had a preliminary reviews document, and now we have an exposure draft. But in that preliminary reviews document, they really didn't address MD&A, management discussion and analysis. That was something that was going to be addressed in the ED. And so this is the first time that we're really seeing some of these proposed changes. Now, we knew that one of their goals was to reduce the boilerplate information in MD&A, right? That's something that they've been telling us was feedback that they've received and that they really wanted to focus on in the standard. They also wanted to really increase the focus on the explanations of the reasons for changes rather than just the fact that they changed, right? So telling me that something went down 8%, doesn't give me the context as to the why. So they really wanted to provide a little bit more detail there, but also reduce repetition within MD&A. So you're going to see here that MD&A in the proposal should provide an objective and easily readable analysis of the government's financial activities based on, and here's something that they really wanted to focus on, what does it mean to be a currently known fact, decision, or condition? So currently known refers to the information that management is aware of as of the date the financial statements are issued. So there is a little bit of clarification there as to what do we mean by currently known. The goal of MD&A is to provide both short-term and long-term analysis of the government's activities. So when we think about MD&A, we should be able to understand it by users who may not be super knowledgeable about accounting and financial reporting for governments. So remember, the intended user here could be the citizens who might not understand some of the nuances to governmental accounting and financial reporting. So when we're writing the MD&A, we're trying to bring it down to something that they can understand, right? Providing explanation, providing interpretations for them to be able to understand this. And so I think that's a really important guideline here, is that we're not writing it for another accountant. We're writing it more for the intended user here. When we think about MD&A, we're going to discuss the current year balances and results in comparison with the prior year, but really emphasize what's going on in the current year, right? So while we are trying to give context, we want to focus on this current year and make sure we understand the why. So as we said, it's not just about telling them the facts, but assist users in understanding why balances and results change from prior year rather than just the amounts or the percentages by which they changed. So they encourage the use of charts and graphs and tables to really enhance that understandability. They also clarified that the focus here is the primary government and it's more of a professional judgment to determine whether you're going to or what matters are going to be addressed related to our discretely presented component units. So again, try to avoid boilerplate templates. And you're going to notice that they're really trying to remove that concept. So they provided very generic information rather than specific because they don't want you to lift it up and then use it. They want you to really provide information useful to your entity. So we're going to have these 5 sections of MD&A: the introduction, the financial summary, the detailed analysis, the significant capital assets and long-term debt activity, and then that currently known facts, decisions, or conditions, including trends, information about subsequent year budgets that's relevant, and then things that happen after year end related to pension and OPEB, capital assets, etc. One area that they also added to the exposure draft here that was not really addressed in the preliminary reviews documents was what we used to think about as special and extraordinary items. So as part of their pre-agenda research, they really looked out at what information, when we talk about unusual or infrequent, or both, right? When we look at this in terms of what that implication is, so we have these special items and then we have these extraordinary items, and they're kind of going to retain this concept of unusual and frequent per GASB 62. However, they're no longer going to make this differentiation. You're going to present unusual or infrequent items individually as the last presented flows of the resources prior to the net change in the resources flows in the government-wide, governmental funds, and proprietary funds. So basically, it's the last line item prior to your change in resource flow. And so when we do this, we no longer have to separate out special. However, one of the differences there was related to control within management. This would now be a disclosure. You would disclose whether the item was within the control of management, but that does not change the presentation of it. We've talked about governmental funds quite a bit, going all the way back to the ITC in this area. And we also talked about the short-term financial resource balance sheet and the long-term concepts here. Going back to the concept statement that we talked about on an earlier blog, right? We have the current financial resource measurement focus and the economic resource measurement focus. We're going to leave the economic resource measurement focus alone, but we now are going to introduce the short-term financial resource measurement focus to replace the current financial resource measurement focus. So we introduced that concept back in the conceptual framework. Now we're going to actually apply it to our governmental funds. And so we're going to have two financial statements, and you're going to notice a change in terminology here. We're going to have the short-term financial resources balance sheet. They know it's a little long. That was one of the feedback that they got from the preliminary views document. However, they feel it's really important to focus on that concept of it being short-term. And the statement of short-term financial resource flows. So no more revenue, expenditures, and change in fund balance. In fact, the term revenue and expenditures are no longer used for governmental funds. So that definitely had to change. In terms of the presentation, we're going to use that short-term financial resource measurement focus. And as we talked about earlier, it's no longer the modified accrual basis, it's just the accrual basis for governmental funds. So if you haven't checked out that blog, I would definitely recommend it because they're leveraging those changes in the conceptual framework and just applying it to governmental funds. Now, when you look at the terminology in the short-term financial resource measurement focus, it focuses on transactions. So a transaction requires an action or actions by one or more of the parties thereto. An action is the transfer of control of resources, i.e. provision of a good or service, that a party to the transaction makes that establishes all or a portion of its rights or fulfills all or a portion of its obligations in that transaction. So as part of this, we've also talked on the blog about the new revenue recognition. So revenue and expense project that the GASB is working on. You're going to see a lot of overlap between that project and the financial reporting project. So definitely want to be paying close attention to this concept because here's where we introduce this binding arrangement. So that's an understanding between two or more parties that creates rights, obligations, or both among the parties to a transaction. We're going to see this concept of a binding arrangement when we talk about performance obligations and revenue recognition. Again, they can be written, oral, or implied. But when we're talking about this from a governmental fund, right, we really want to make sure that we understand the types of transactions. And so we have long-term transactions that typically from inception take more than a year, right? A note payable that's due in 5 years, right? That's a long-term transaction versus a short-term transaction, something that typically from inception happens in less than a year. So accounts receivable, right? Typically 30 or 60 days, the cash has been received. However, in addition to transactions, they also say or other events. And so that's based on the occurrence of the event. So inception is when the event starts and the conclusion and when the event ends. And so we're going to need to take that into consideration in the application of the short-term financial resource measurement focus. Now, one thing that they did address was the exception. So in the exposure draft, in the preliminary views document, the last update that they had provided prior to the exposure draft, they had proposed the concept of normally, if something was normally due within a year. In the exposure draft, they took that out and they said, what is the actual contractual arrangement? However, to deal with what they were really focused on, which were tax anticipation notes and revenue anticipation notes, they do write in an exception here. And long-term debt issued for short-term purposes would be recognized as a liability in the governmental fund. So even though it's a long-term debt, so say it's a 15-month tax anticipation note, it's for short-term purposes, right, to pay, to make coverage for what we need right now. In that scenario, it would still be shown in the governmental funds, even though it exceeds that 12-month period that we would normally not be showing those type of arrangements for, because that would be in excess. And so we look at short-term transaction when it occurs. We look at long-term transactions when they're due, because that would typically be a long-term transaction. It wouldn't be in the governmental funds. This is the exception to that. So they are addressing that here. They also introduced the types of elements. So along with this update to the conceptual framework, we're going to have our assets and liabilities. We're going to have inflows of resources and outflows of resources. There's no longer the term revenue or expenditures for governmental funds. And this is something that really goes into the revenue and expenses project, but also truly trying to differentiate when you're in governmental accounting, when you're in that short-term focus versus the long-term focus, government-wide financials, et cetera. We'll still have our deferred inflows and outflows, and then inter-fund balances and transfers are recognized as short-term transactions, even if the events from which they arise would normally be a long-term transaction. So again, another little bit of exception. So here is an example of a short-term financial resource flows statement. So you can see here you have your inflows that would be detailed out, your outflows, which would be detailed out and then totaled. Then you'd have your total current activities. Then you'd have your non-current. So again, if you have transactions related to those current activities versus those non-current activities, we are going to separate them on the resource flows. Then those unusual or infrequent, again, removing that concept of special and extraordinary, and then our change in fund balance, and then the reconciliation. It must be in this sequence, and each caption, subtotal, and total should be presented as applicable. So this is sort of the format that we would expect to see. We are going to still have the same governmental funds with one twist because we no longer have revenue. It will now be the Special Resources Fund as opposed to the Special Revenue Fund, since we don't have revenue for governmental funds. So these would be proceeds of specific inflows from short-term financial resources from which current activities other than transfers that are restricted or committed to use for specified purposes other than debt or capital projects. So very similar concept to our current definition of special revenue fund, but again, trying to use the terminology that makes sense. For our proprietary funds, again, this is part of the proposal that they had in the preliminary reviews document. We are going to continue to distinguish between operating and non-operating. However, we're going to define operating and non-operating. Today, entities get to make that definition for themselves. Under this model, operating revenues and expenses would be everything that's not non-operating. Non-operating are going to be our subsidies received and provided, revenues and expenses related to financing, resources from the disposal of capital assets and inventory, and then investment income and expenses. So if it's not non-operating, it's not on the list here, it's automatically operating, except, because it's very rule, we have to have an exception, if it's the fund's principal ongoing operation. So if you, for example, were doing loans to first-time home buyers, then interest revenue would still be operating, even though interest is deemed to be non-operating in that list, right? So you still do want to look at the underlying principal operations there. For our proprietary funds, they are going to have some new required subtotals, our operating loss, our income, and our non-capital subsidies. And we do have a definition now of subsidies, which are resources received from another party or fund to keep rates lower than would otherwise be necessary to support the level of goods or services to be provided, or resources provided to another party or fund that results in higher rates than otherwise would be established for the level of goods or services to be provided. And so that second half was really added in the exposure draft. The first half would have stopped it before that or. So you can see they do provide, again, another example of what this would look like. So you can see your operating revenues, your operating expenses, your non-capital subsidies, then your other non-operating revenues, your unusual or your infrequent, and then your reconciliation. Again, must be in this sequence, must have each caption, subtotal, or total. Very similar to the preliminary views document. Right now, you can have a choice between a statement or RSI. Going forward, the budgetary comparison is going to be RSI, and you're going to be required to present final versus budget, final budget versus actual, and original versus final budget. Consistent with what they had said earlier, for major component unit information, if you cannot present the component unit in there because you've sort of run out of columns, it's too wide, then the financial statement of the component unit would be presented in the combining financials after the fund financials. So just trying to find a consistent way for government to present this. They also add here for the statistical section, governments engaged only in business type activities or only in business type activities and fiduciary activities should present revenues by major source for their BTA, distinguishing between operating and non-capital subsidy and other non-operating revenues and expenses. Things that were in the exposure draft, in the preliminary views document that they decided not to continue forward with, the debt service fund presentation. There was this consideration of how we were going to make changes to that. It wasn't proposed in the preliminary views document. They said they were going to address it in the exposure draft. They decided to drop it. In the preliminary views document, they did recommend functional and natural classification for government-wide financial statements. That was removed in the exposure draft. And they had kind of gone back and forth on requiring a government-wide cash flow statement. They ultimately decided that the cost-benefit analysis just wasn't there. So one thing that they've added that wasn't in the prior preliminary reviews either is a proposed effective date. And consistent with the last time we updated our financial reporting model, they are looking at sizes of governments. So if a government has total annual revenues of $75 million or more, it would be fiscal years beginning after June 15, 2024. Governments with total annual revenues of less than $75 million would be fiscal years beginning after June 15, 2025. So it sounds far away, but time keeps passing by so quickly. Early application is encouraged, and all component units have to implement it in the same year. So that's going to go into that total annual revenue consideration. All right, I know this is longer than our typical blog, but it was a big standard, and I did want to make sure that you were getting all the information that you need. It's many hundreds of pages, so definitely take a look. There's some really good examples in some of the appendices, so I would definitely make sure that you take a look and consider providing some feedback to GASB. This is a major change to our financial statements, and so it's our opportunity to help them make sure that the changes are operable, auditable, and reasonable. So it's your opportunity to provide feedback. Hopefully the overview helped, but I would recommend taking a closer look at the document if you are so moved. So thank you guys so much for joining me on the Genuine Learning blog. I hope to see you on a future blog. Have a great day, guys. Bye-bye.